right. Thank you everyone for joining us today. It is currently just past 5 p.m. in London, and we have a community of people joining us from all over the world today. I think on the back of the last market overview, which we had a record attendance, it's been an incredible month in the crypto markets and then broadly on the macro. Looking forward today to be joined by my colleague Garrick Heilman, as well as Sam Harrison, who joins us from the Blockchain.com Ventures team. So we've got a really exciting overview, and obviously it's been a very intense 24 hours in the markets and broadly in the context of the American election. We'll be speaking to that today a little bit and digging right in. So I'm very grateful to welcome everyone. We'll get started now. So my name is Nicholas Carey. I am the co-founder of Blockchain.com. I was also the founding commissioner of the Blockchain Commission for Sustainable Development and the co-author of The Future is Decentralized. I want to tell you a little bit more about Blockchain.com and what we've been up to. Our team has been quite busy over the past month. So go ahead and push the slides through here. For those of you that don't know, Blockchain.com is most widely known for the software we build that makes it easier for all people to send, receive, secure, trade, exchange, and invest in different digital currencies. So the first one of those was Bitcoin, and now there are many more. We'll be talking a bit about those assets as well as the crypto markets in general today. But the portfolio of features and products that are provided by the Blockchain.com platform include the wallet, which you can download for free from the iOS or Android store, as well as sign up for on the web. We have the Blockchain.com exchange. It's the world's fastest exchange, and we've got a great banking network, including dollars, euros, pounds, and the Turkish lira. So if you're interested in a more professional trading venue, we welcome you to visit the exchange, and we've launched new assets over the past 30 days. So we'd love to have you check those things out. The Blockchain.com Explorer continues to be one of the most widely accessed and used websites for any of the crypto curious, looking to see what's happening with transaction velocity, as well as confirming the transactions that are happening on the public ledgers. So definitely check that out if you're interested in learning a little bit more. The investment products we have here include Blockchain.com Ventures, and we'll have Sam join us today to talk a bit more about that. So anyway, lots of stuff to explore at Blockchain.com. Please check it out. And I want to give you an update on what our team has been busy doing over the past 30 days. So we've implemented a really clever handoff between the mobile apps and our KYC process for onboarding users into our gold tier. So that makes it possible for people to trade at higher limits. And so welcome anyone that wants to explore that to test it out. We've launched a new feature on Blockchain.com, which is our buy widget. And we're seeing a lot of uptick for new users immediately buying crypto using this great feature. We've made it faster than ever for people to get into crypto just by clicking on that. So give it a shot. The Android app has received a whole bunch of updates. So definitely keep that current if you haven't already downloaded it. And we're really pleased to announce the launch of several new assets on the Blockchain.com exchange, including Aave, Engine, and the Origin tokens. So those are all paired up on the Blockchain.com exchange. Welcome you to test those out as well. And the Blockchain.com podcast is officially live. So Dr. Garrick Heilman, who produces a lot of world-leading research, is speaking succinctly to many of those topics, and those will be available anywhere that you can get your podcasts. So on the App Store, Apple, all the FM stations and more. Please subscribe to that. We'd love to get your feedback as well and hear what topics you'd love us to explore with you. And that kind of succinctly summarizes all the work that's been happening by the team over at Blockchain.com. So we thank all of our customers. Here are a couple screenshots of the latest apps, including the wallets. So make sure you keep those things current by downloading the latest versions from the app stores. And then finally, simple trade on the exchange and our interest products are incredibly popular right now. If you didn't already know, you can use this feature to deposit crypto at Blockchain.com and earn interest on your crypto. So if you're long and want to earn some income off of that, we definitely suggest using these features. They're used now by customers all over the world in over 140 countries. So without further ado, I'll be passing along to my colleague, Dr. Garrick Heilman, just in a moment. Last time we spoke, we covered the market outlook, Bitcoin OnChain Insights. We did a technical overview with our colleague, Charlie Magera, and we spoke to the CEO of Algorand, which is also an asset supported on the Blockchain.com exchange, learned a little bit more about their roadmap and the exciting community that supports that work. So today we have a lot to discuss, and it has been a very busy month. So we'll be going over the market outlook, again, looking at on-chain analytics for any clues to study adoption and more. And then our special guest today is Sam Harrison, someone I speak to on a regular basis to better understand emerging trends and what's happening in the cryptocurrency ecology and investment space. So we're really lucky to have him join us. And without further ado, I'm going to pass it on to my colleague Garrick here. So for those of you that don't know, Garrick is one of the first people to ever, broadly speak, and spend their careers focused on cryptocurrencies. He's the head of research here at blockchain.com and one of the most cited cryptocurrency and blockchain technology researchers globally. He taught and created the first course on blockchain technology at the University of Cambridge and has authored leading research on cryptocurrencies and alternative currencies, and even wrote his dissertation on the subject. He's ranked as one of the most 100 influential economists in the world and regularly featured on BBC, NPR, Wall Street Journal, and many more. So I'll pass you in the very capable hands of my colleague, Dr. Gary Connell.
Great, thanks very much, Nick. So we just got through Halloween, and very different Halloween for the trick-or-treaters out there this year with the pandemic. But from a crypto perspective, this is a very important date, as probably many on this call know. This was the date that Satoshi Nakamoto released the Bitcoin white paper, now 12 years ago, a dozen years ago. And each of these milestones is very significant, and it's why we talk about them. The longer that Bitcoin and cryptocurrencies continue to exist, the more cemented they become, in the financial and economic and technology landscape. And these milestones have a really important psychological effect on both active crypto participants as well as people who are still thinking about whether they should use and adopt crypto assets. So we saw a really great month in October for Bitcoin. This summer we've been highlighting a lot of the great activity on Ethereum and the DeFi networks. And Ethereum continued to have a strong month, up 6%, but really Bitcoin stood out, up 28%, one of its strongest months of the year since the Black Thursday sell-off in March. And there's a couple of things that are worth highlighting here about why October was such a positive month for crypto assets. You'll note that stocks were down, gold was down. We saw a bit of a decoupling, which we talked with Charlie about last month, and why that was important, that crypto certainly gains and benefits for when it's not trading like a Nasdaq tech stock and strongly correlated with equities. We saw crypto kind of doing its own thing again, which is, I think, constructive and positive. The other big thing that happened last month is we saw the long dated U.S. Treasury bonds drop significantly, down 4%. One of the things we've been talking about is, financial repression and concerns that people who are getting squeezed by low interest rates, what impact that might have on the bond market. And we're seeing the bond market selling off here a bit, which may prompt further Fed action to try to control yields. So Fed action generally has been very constructive for crypto. There's the popular meme, money printer go brr. These things are certainly very, very good for crypto, and they're algorithmic and force scarcity. So I just wanted to touch on something else. We've talked about equity markets a bit, and just briefly, we've seen, if you look at 40 years of history in the corporate credit markets, we've seen a pretty significant deterioration in corporate credit. There were over 100 AAA rated companies several decades ago. There's only 5 AAA rated debt companies today. You've seen a real expansion in lower grade credits. And why this is significant for crypto is that, again, as crypto becomes more institutionalized, as we see this kind of crypto Wall Street convergence, which we've written about, you're going to see institutional investors looking for alternatives as their options in equity markets become maybe less attractive. And credit's an important part of the story. We've got a pandemic still going. We've got severely degraded and damaged balance sheets across many parts of the economy, the commercial real estate sector, and so on. And so this is another factor that you need to kind of consider when thinking about what could force or cause institutional investors to consider maybe reallocating some of their funds away from equities and corporate debt markets into other asset classes like crypto, something to keep an eye on for sure. And of course, we just had an election last night. It's not finished, as you know, I think we all know, and Nick alluded to this. A lot of questions about what this means for crypto. You know, we titled this this month's outlook, why censorship and tamper resistance are more important than ever. We've seen a lot of concerns around, tampering with election outcomes, censorship on online platforms. These are things that blockchain technology and cryptocurrencies were really designed directly to address. The ability for people to express themselves in a number of ways, financially, through communication, and also speed as well. I mean, there's a lot of talk about how, boy, Bitcoin transactions can take a long time to confirm sometimes, but they do confirm relatively quickly compared to certainly the delays we're seeing in getting some votes counted. So we think the election has really reinforced the need to kind of upgrade our infrastructure in a number of ways beyond just the financial side of things. We wouldn't be surprised to see, more interest in blockchain technology broadly for things like, social media platforms, maybe some voting technology. There's been a lot of challenges around the security there with those, but the election certainly has emphasized that. And in terms of the outcome and what that means, it's important to remember there's a lot of things that are, kind of operating here beyond this election. The pandemic has really forced governments around the world to kind of increase their fiscal spending. Not sure that really is going to change dramatically with the election. There's a lot of, companies and people who are still in deep trouble, and they're going to need to be supported with either fiscal or monetary policy or both. And so we expect that really to continue regardless of the outcome. Nick, I don't know if you wanted to come in and share any thoughts on the election and what it means for crypto.
Yeah, thanks, Garrick. So, obviously there's a lot of tension across the macro space today, the pandemic. The UK has entered a new lockdown, and the Bank of England today announced another $100 billion in quantitative easing. And so the discourse and dialogue around what are the implications of this in the market are really becoming sharply into focus. I think anyone that's been studying the cryptocurrency community for a while will know that a lot of people that are participating in it are here using their time as a vote and using the technology as a way of building potentially a complete alternative to many of the institutions and trust fabrics that we've all inherited that are flawed. And there'll certainly be some significant challenges to the future, I believe, but the work that's happening across the industry is quite promising. For the past 10 years, I would say the first sort of primary use case of cryptocurrencies was to prove out whether or not they'd be useful in the peer-to-peer transacting, essentially a form of digital cash. And some of the more futuristic applications of the same technology are certainly applicable to being able to provably vote in a democratic process of some type, a governance model, and much more. And we'll be speaking with Sam in just a few moments and actually getting his views on some of the different ways that the technology is more broadly applicable to some of the kind of intense challenges that we face. And so all the challenges that we do face are always sort of opportunities that can also be addressed with, I would say, good use of energy and effort and investment. And so we'll be really excited to hear Sam's views on these things. And the election obviously is certainly top of mind for everyone, and the market, at least in crypto, the last 24 hours has been quite receptive to the predictions that are coming through. And so I don't think it's too much of a surprise to see crypto reacting quite favorably to the macro economy right now, the move of everyone going to a more digital native fabric and the internet kind of proving itself to be the growth engine probably for the next few years, having digitally native assets over the internet makes a lot more sense than ever before. And so as we start to cooperate and coordinate across borders more regularly with digital information, digital money seems quite logical as well. So I'll pass it back to Garrick. We have some on-chain insights revealed to us by our team of data scientists, and we're always looking at the blockchain itself to get some signals and sense for what's happening, and look forward to hearing Garrick's views on this.
Great, thanks so much, Nick. So these are some of the kind of on-chain insights we wanted to highlight this month, which we'll also be writing up in the written report in more detail, but we just will briefly touch on a few highlights here verbally. So we saw a big decrease in the hash rate. There were a lot of questions around whether this should raise concerns. The move was not massively different than some of the other declines we've seen throughout the year in the past. So it's not something personally that raised a huge concern. There was speculation that this may be related to the annual migration of Chinese crypto miners, between the different parts of China as flood season shifts and people move to different parts to take advantage of lower cost electricity. Interestingly, we did see a decline in network activity, possibly related to this decrease in hash rate, because as hash rate declines, the ability for the network to speedily find blocks and process transactions dips. And so across the board, we saw number of blocks mined, number of transactions go down, and a big spike in the fees as well, which we'll touch on. In fact, we saw the highest fees we'd seen in 2 years, towards the end of the month there on the 31st of October, actually, with fees spiking up above $12 a transaction. But built into the Bitcoin protocol is the difficulty adjustment, which we saw a massive drop in the difficulty of finding a block, basically. And that's kind of the secret weapon, of course, of the protocol to adjust for these big shifts in the hash rate. So one thing we wanted to highlight, which we thought was quite interesting, and there was huge news last month of PayPal, which has hundreds of millions of customers, following through on the earlier rumors that were kind of circulating this year that they would be embracing crypto assets, and they decided to support Bitcoin, Ethereum, Bitcoin Cash, and Litecoin. We thought it was quite interesting that blockchain.com's wallet activity, a non-custodial wallet, very different format for using and interacting with cryptocurrencies, and PayPal's more centralized approach, where you can't even deposit crypto with PayPal, you can't withdraw. It all lives in essence on PayPal's internal database. We saw a big increase in blockchain.com's share of Bitcoin network activity. Percentage of total transactions represented by blockchain.com wallets was up over 36% in October from 34% in September, which is higher than it's been historically in many months, where it's been more in the 25% range roughly. So we don't know if there's a direct link here, but we think it certainly is interesting that people continue to take a strong interest in owning their own crypto, holding their own private keys, and having a very different cryptocurrency kind of level of control than what centralized platforms like PayPal are offering. Another thing we thought was quite interesting is just looking. We monitor hash rate distribution across the different mining pools, and OKX has been in the news recently. There's been some questions about the location of the CEO, some problems with withdrawals. And their mining pool has really just fallen off a cliff in terms of the percentage of miners that are choosing to use the OKX pool for mining purposes. And perhaps that's related. We're not sure. There's still a lot of questions around what exactly is going on there. There's, throughout the years, as Nick and others can attest, there's always been a lot of questions about activity in China and regulatory clarity and so on and so forth. But we did notice a big drop in the OKX pool and wanted to bring that to your attention. Okay, so now on to the main event here. We are absolutely thrilled to now bring Sam Harrison, head of blockchain.com Ventures, into a conversation with Nick and myself, and also we'll be taking questions, of course, from the audience. Sam, I'd love to just hand it over to you now to kind of talk through some slides you wanted to include, and then we'll go to the Q&A discussion. Welcome, Sam.
Thank you, Garrick. Thanks so much for having me. So just wanted to present a couple of quick slides here to give some context and some framing for how we view the world at Blockchain Ventures. And then we'll quickly go through those and open up to the fireside chat. So as you see on the screen here, a very simplified view of the world. We have kind of three main buckets of investment and type of investment that we can make in the blockchain space. The protocol layer, the infrastructure layer, and the application layer. So just to define these and kind of provide clarity on what we're thinking, the protocol layer, these are the layer ones, that's what they're also referred to, underlying blockchains. They're a set of rules and standards that govern how blockchain works. So Bitcoin's its own blockchain, Ethereum is its own blockchain, Zcash, Monero, Near, Solana, all their own type of blockchains. They have different standards, different block times, different ways of reaching consensus, and they're agreed upon by the people that operate on those blockchains, and that's effectively how they work. So I like to, in a kind of more basic internet analogy, liken this to FTP or HTTP, POP3, any of the protocols that make the internet work. These are the same in the blockchain world. And then we have the infrastructure layer, and these are the tools that allow applications and users to interact with the protocols without really knowing how the protocols work. They obfuscate the technology. They're the gateway to using this technology. And in the blockchain world, that manifests itself as wallets like blockchain.com, explorers, app and dApp browsers, exchanges, maybe nodes as a service, any of the tooling that makes this whole set of technology work, but obfuscates it completely. So you don't need to know that a Bitcoin block time is 10 minutes or an Ethereum block time is 10 seconds to engage with those protocols. That's what the infrastructure layer is there for. That's, picks and shovels. And in an internet analogy, again, that's kind of like your Google Chrome. That is your infrastructure that allows you to engage with the protocol layer. And then at the very top of the stack, you have the application layer. These are the pieces of software that actually provide utility, an end service to the user. That's what users are really excited about. That's what they come to use. They don't come to, people don't use the internet to use FTP or HTTP. They come to browse Facebook, view content on YouTube, maybe trade stocks on Robinhood. All of those are examples of application layer. And we have a set of applications that are built specifically on blockchains for blockchains. And they can be truly decentralized, or dApps, sometimes referred to, or applications that use blockchain but have some component that's centralized as well. And examples of these, maybe you have some prediction markets, which have been in the news recently, given all the action that's happening on the election. You can have marketplaces, remittance platforms, anything to do with cross-border finance, perhaps a platform to trade event tickets or pool insurance. These are the things that, again, ultimately provide utility and what we think will bring users into the blockchain arena. So if we just flick forward to the next slide, I think the part that's important to the way we view the world at Blockchain Ventures, we just don't think there'll be that many protocols. There doesn't need to be that many protocols, the same way there's not hundreds of programming languages. There's maybe 10 or so that really matter. They kind of follow a power law distribution curve. We think it will be the same for the protocol layer for blockchains. There doesn't need to be 1,000 blockchains. Whenever you make an architectural or philosophical decision about a blockchain, for example, how decentralized should it be, how that decision has a trade-off. More decentralized typically means slower, more expensive to transact. How private should it be? Again, you make trade-offs around whether it's fits in within the regulatory regime or not. And also additional privacy means more computation intensity, which often means it's more expensive to transact, et cetera, et cetera. So every time you pull on a lever when it comes to a protocol, you make a design choice that means there's a trade-off somewhere else. But given that, there's only so many permutations of a blockchain that really need to exist. And ultimately, we believe the mass consumer will come to use blockchains not through love of the technology, although many of you on the call may feel that way because I guess we're all at the cutting edge at this point if we're dialed into this. But the mass mainstream, they come to do something like trade an event ticket, send an instant remittance, or even store US dollars in a high yield interest account, perhaps in a part of the world where that's not possible to do. So that's the lens that we've been investing through blockchain ventures.
Great, thanks, Sam.
And just up on screen is impossible to talk through all of these. Hopefully, some familiar names. These are the 16 investments that we've made out of the fund so far.
Great. And just while we've got the slides up here, I just wanted to touch on one question before we kind of stop the screen share, which is your approach to investing across these different levels here. You mentioned how the focus is on infrastructure and application. Can you speak to whether there's kind of a rough percentage or balance of investments you'd like to make across applications and infrastructure, versus is it more really about the team and the fit and the specific investment that's really dominating your thinking, or do you try to keep some percentage balance between those two categories?
Yeah, there's definitely some portfolio theory at work here. We're not too dogmatic. We haven't set specific percentages. We have to be somewhat reactive to market conditions and the quality of project and team that comes along. It's actually the same, by the way, for whether we invest in equity or token or some kind of combination of both. We don't want to be too regimented, because if you try and force everything into a specific kind of allocation, you may end up missing out on really great deals. So the split between application and infrastructure, I'd like it to be 60-40, 50-50, something like that, where it's fairly even. It would not, I don't think, make sense from a portfolio theory to place all of our eggs in one basket. But if it ends up being 70-30 in the favor of either of those, that's fine. We're probably about 50-50 at the moment, and we have one general purpose protocol and one very specific protocol investment, the latter being Theta and the former being Near protocol. And we made those investments because although we don't think there will be many protocols, they're ones that are exceptional in what they do, and they've developed great communities, and we think they really have a chance to be one of the 10 or so protocols that has a going concern in the next decade or so. And that's because of the quality of the team, the tech, and the community that they built. And the applications that have been begun building on, particularly in Near, are extremely exciting.
Great, thanks, Sam. I'm going to stop the screen share now, and then Nick, did you want to come in?
Quickly. So it's been a long time since I interviewed Sam about this, so I'm curious to get the story again. So Sam came to us after 4 years working for Naspers, which is a legendary technology investor. I actually just wanted to have you maybe share your story a little bit about how you got into venture investing and how you ended up kind of concentrating specifically on cryptocurrencies, specifically.
Yeah, so I'm from the UK originally. My first proper job, I guess, was in finance. I worked at Morgan Stanley, and it was there that I both discovered what Bitcoin was, read about that in The Economist in about 2011, and ended up, my housemate paid for his share of our joint rent in Bitcoin to me, and I paid our landlord in pounds. And that was my first exposure. Did not read the white paper, did not even buy it myself. So it's kind of an interesting accidental story, which I guess you're pretty familiar with that at this point, Nick. But yeah, so I fell into it by accident. And then when I was at Morgan Stanley, I also had been making iPhone apps. This, again, 2011, the iPhone had become a thing. and I was just dabbling around with this kind of new technology, and it seemed like there was lots to do there. So I was making very, very low quality iPhone applications, not by choice. That was just as good as I could make them in kind of my spare time. And that's when I realized, I really like technology. This Bitcoin thing is really interesting. Maybe I should do venture. That kind of combo is a combo of technology first, maybe finance second, where I was doing predominantly finance stuff at Morgan Stanley. So that was how that happened. I went to Cambridge, did an MBA, and got hired by Naspers to move to Asia to lead their earlier stage investing.
Wow, that's a good story. Paying rent in crypto in 2011. That's not everyone can say they did that. I think one thing that'd be interesting for the audience to learn a little bit more about is how do you structure risk in these investments? And I mean that I think in most tech, investors are really concerned about governance and how are they going to make sure that there's an alignment of incentives so that the management team and the stakeholders are all sort of marching in the same direction, that they're creating enterprise value for, say, a company. But in cryptocurrency, you have really different business models, especially when there's a tokenomic component to that. So maybe partially define those terms, and then also talk a little bit about how you think about aligning incentives when doing investments specifically in cryptocurrency projects, protocols, or companies.
Yeah, it's a super interesting question. The simplest part of the answer to this is, when we invest in an infrastructure company, for example, it often manifests itself as an equity investment. And therefore, although it services the blockchain, it has all of the same kind of investor protective provisions and standards that you would have in a normal venture investment, and may look quite a bit like a SaaS company or a consumer company in the case of a wallet. So in that example, it's actually no different. Where it gets complicated, to your point, is when there's a token component. How do we make sure that everybody is aligned? And again, on the simpler side of this is, if it's only a token project, then it's, and we own token, the team owns token, the rest of the community owns token. Again, it's fairly easy to think that there would be alignment. Now, the proper safeguards need to be in place. I don't think the industry was mature enough, say in 2017 for this, but you see it now, where there's very strict vesting schedules, there's cliffs, there's 3-4 year team vest, linear after a 1 year cliff. Same for investors, we're all in the same boat. So if you're buying in at the pre-sale before the token lists, you're signing up to be a long-term investor, and there's restrictions around what you can and can't do. Often you can participate on the network as a staker or validator, but you can't transfer or sell your tokens. So that you're in the same boat as the team. And really the goal is that you all work to making the token as valuable as possible, and everyone's exactly aligned. Where it gets complicated is there's some equity fundraise. Some people have put money into the company with the expectation of making more money on the equity side. And then there's a token that's released as well. And obviously there can be friction if there's different stakeholders that own one or the other, but not both. So we typically, if that is the situation, try to own both directly. Some people are okay with maybe the equity owns a portion of the tokens, and therefore they have an indirect holding of token via the equity's treasury. That's okay, but I think being able to own a similar amount of both equity and token, if they have been sold with the expectation of profit, is the simplest way to make sure everyone's aligned. And again, just to close the loop, we really don't mind if it's equity or token when we invest, as long as it makes sense given that business model, and as long as there's complete alignment around our interests, the team's interests, and the rest of the investors.
Super interesting, and pioneering a really investment landscape unlike any other. Some painful lessons, I think, learned by teams in 2017, though, during the ICO boom. Seems like those are getting corrected now. I'll pass it on to Garrick. I know he had some thoughtful questions he wanted to peruse with you.
Great. Yeah, thanks, Sam and Nick. So Sam, this is something you and I've talked about previously, gestation periods, how long it takes for crypto projects to develop. We've seen comments from Fred Wilson, others, lamenting, Ethereum scalability and how slow that's coming along. And I just wondered if you could talk about the timing challenge. I mean, timing is always such a huge, tricky part of investing. But tell me about that in crypto, and and how you're seeing the whole ecosystem evolve, and how you think about that as an investor from a risk perspective.
Yeah, it's funny. Through one lens, it moves quite slowly. ETH 2.0 is a great example of that, and looking how long it took, say, Definity or a Filecoin to come to market. It's clearly very difficult to build these things, and therefore sometimes it feels like it's moving slowly. But also, the Bitcoin white paper is like 12 years old now, and therefore the whole sector is still very, very new, and the level of innovation and activity, total value locked in DeFi, complete market cap, all of these things are, when you take a step back, things have moved very, very fast. So, but I guess, the scaling question hasn't quite been answered as quick as most people had wanted. I think it's because building blockchains and blockchain applications is extremely difficult. And on the application side, a lot of the tooling that exists for Web 2.0 hasn't historically existed for Web 3.0 or blockchain applications. We're seeing lots of nodes as a service, node management, software, identity, the ability to just push messages to your users, all of these things that exist and you can use SDKs for in Web 2.0. You don't need to reinvent the wheel. Developers can just grab something off the shelf, implement it into their application very, very fast. Have not historically existed for Web 3.0. They've now been built, and it's much faster to spin up an application or an Ethereum using all of the tooling that exists. And we've invested in companies that allow people to do that, such as Blockdaemon. And then, for the layer ones, that stuff's clearly very challenging because it's at the forefront of game theory and microeconomics, and also cybersecurity and cryptography all bundled in, and token economics all bundled into one thing that needs to be done right, otherwise it doesn't work. So I think, again, layer ones will continue to evolve slowly. They will continue to push out the frontier slowly. And in the interim, the rest of the sector is developing the tooling to work around the nuances that exist on building on blockchains. And one of the ways that we mitigate the risk of the kind of long gestation period is we only invest in projects that have built something. It doesn't need to be perfect, but we can get our hands on it and say, okay, this team is capable of building whatever they hope to build, because it's extremely challenging to develop on blockchains. And therefore they've proven that they've got the capability to do that. It doesn't need to be a huge application or piece of infrastructure, but it needs to be tangible. So that's kind of our workaround for preventing investing in things that 2 years later still don't exist.
Got it. And that's a great segue to the next question on in terms of product market fit, and you're not necessarily looking for something that's showing the hockey stick, like we saw with DeFi this summer, more that something is built that aligns with your investment thesis and has the capability, of course, to take advantage of something like DeFi, what we saw this summer and the huge growth, but it doesn't have to have that demonstrated kind of hockey stick right out of the gates before you get involved, or I don't know.
I've never thought about it that way before. It's an interesting question. Hockey stick's good. The problem, by the time you've demonstrated the hockey stick, the valuation is at a point that price is in the hockey stick. So the trick is get in just before the hockey stick. And we've been fortunate enough to have done that with a couple of companies recently, where they were just reaching an inflection point. We invested, and the timing was good, and they've hit that point. But yeah, we definitely don't need to see a hockey stick. Ideally, if it's a consumer-facing application, we can look at how people are using it, and it's not unlike a general venture investment. What are the cohorts like? What's the engagement like? How often are consumers transacting on a monthly basis? Is the transaction size growing? Is their deposit amount growing? All of those things are kind of illustrative of people have found the product and they're really enjoying using it. Doesn't need to be a huge number of people at this point, but the audience that they've addressed is really engaged and loves what's been built. And then you need to take the view, okay, is that audience niche and will remain niche, or is that audience niche but soon to become mainstream as soon as the awareness is there and the user experience is slightly better? So that's, I guess, what we're doing. We're making assumptions on what the future looks like and whether the few data points we have are illustrative of, yes, other people are going to really enjoy doing this as well. And some of it's, it's not a huge stretch to imagine that if you live in Venezuela or Argentina and you suffer from very, very consistent decades-long purchasing power erosion, you might be interested in a US dollar savings account that's, powered by a stable coin that yields 12%, something like a blockchain.com wallet that is quite appealing versus Bolivar or pesos, where your devaluation against the dollar and high inflation and restrictions on what you can do with that currency exist.
Great. I have one more, and then I'll hand it back over to Nick, if that's okay. This actually comes in from Jason Karsh, our VP of Marketing. He was wondering if you're looking for a particular company or product to invest in, but it simply haven't found it in the market yet, either because it's too early or the right team hasn't come together.
That's also an interesting one. Yeah. I think the one area that I've been very interested in for a long time, but have not quite seen develop yet, is this concept of smart contract insurance, peer-to-peer or pooled insurance. It has different names where, and this is having looked a lot at insurtech more broadly before doing solely crypto investing. Insurance is a product that's mostly a grudge purchase, and most of the premiums paid end up not being paid out to users when they make a claim. And therefore you have this constant friction between the consumer who's buying the policy, often because they need to, and the insurance company that kind of really doesn't want to pay out, but they will do. And they're really only making money on the float. It's the combination of their OPEX, which is quite large, and and all of the claims that adds up to almost 100% of all premiums. But it's this part, this operational expenditure can be up to 50% plus of all premiums they take in, depending on the category, just gets spent on bureaucracy, running the business, paying salaries, trying to deny or pay claims, whatever it may be. So it's this clear misalignment between the business and the consumers in insurance that interests me, and the fact that it's people just pick the cheapest one. There's no loyalty. It's a grudge purchase. If you look at what you can do in certain categories with smart contract insurance or pooled insurance, maybe Nexus Mutual is the best example of this, but it's not exactly that. So I just throw that name out there for those who are familiar with it. Anybody can contribute capital to insure against a certain risk, and they get paid a return for doing that. It's a very interesting kind of asset class in a low yield world. And then on the consumer side, you can buy a policy directly from a smart contract that pays out based on certain events happening or not. For example, crop insurance, where you nominate the fields that you want to insure, and then there's an oracle that says there was or was not X amount of rainfall. And therefore, based on that rainfall data, the smart contract can automatically pay out. The same can be done, for life insurance. There's clear public records of life and death, and there's multiple ways to check that. The blockchain can look at those and automatically pay out in the instance of something like that. It gets more complicated with more complicated forms of insurance. Those are kind of binary. Did the crops fail or not? Is the person alive or not? If it's a car crash, for example, how much damage was done? And that's where this kind of breaks down, hasn't been solved yet. There are good databases for car crashes, but then there's nuance around what type of claim and how much should be paid out. But the concept of pretty much 100% of that insurance pool can now be paid out in claims. So the premiums can be 50% lower in theory, or the payout amount can be 100% higher. Given the efficiency that there's no operational cost of running this thing, I think it's really, really interesting. And then you combine that with DeFi, the float, the premiums that have been paid can be invested and earn quite a high yield as well in a fairly risk-free, no counterparty risk manner. So I think that concept is truly fascinating. I think the world will be a better place, but it's not quite there yet.
Yeah, no, I'm right there with you. I don't know anyone who enjoys going through a claims process just from a user experience perspective, being able to automate, getting paid out if an event occurred would be a huge win for, so I've wondered about insurance for years myself. Thanks so much for that. Nick, you want to?
Yeah, I'll wrap it up here. There's a tremendous opportunity there. I think it's like least favorite things are probably like dealing with real estate agents, renting a car, and then like insurance. Anytime you have to interact with these highly transactional, very inefficient, user experiences, it's just really an opportunity for someone to come and reinvent it. And speaking of that, we had a question come in from the audience. I thought would be perfect for you to answer, Sam. So, what is the ideal way for founders to pitch you?
Interesting one.
Someone's being opportunistic, I think, which is great. Love it.
Yeah, that's an interesting one. Like the ideal way is get an introduction from another fund that you work with, someone that you know well, that we also know. That's the best way. The other way is there is a part of our website that allows you to actually submit a form. I forget what it's called, but if you go to blockchain.com/ventures, it's the most prominent button on there. If you click that, you can run through quite a streamlined process, enter a few data points, and then we'll definitely reach back out if it's within, kind of fits within our thesis. So they're probably the two best ways. Otherwise, you can reach me on LinkedIn or try me on Twitter. Also good ways.
All right, great. Well, I think that'll pretty much bring to conclusion our overview today. I wanted to thank Sam for his time of sharing his experience at the kind of tip of the spear and investing on the emergent teams and projects and protocols across applications and more that are basically shaping the future of the cryptocurrency industry. So thank you, Sam. And thank you, Dr. Gary Heilman, as usual. And we thank everyone for joining us. This presentation will be available on YouTube, on Facebook, and as well on our recent podcast. We welcome everyone to subscribe to that. We wish everyone a very happy November. November's usually been a fantastic month historically for crypto, and with all the events happening in the world today, I think it's definitely a time to stay tuned. So thanks, everyone. Have a great day.